If you've spent 40 years building a retirement nest egg, the last thing you want is to watch your life savings evaporate in a market correction that takes you by surprise. Yet that possibility is hiding in plain sight in Goldman Sachs' latest research. In January 2026, Goldman Sachs published their official outlook for the year with a bold prediction: the S&P 500 would reach 7,600, delivering solid gains to investors. But buried in that same report is a mathematical confession that contradicts everything in their bullish headline. This is the story that financial professionals are discussing privately, but investors aren't hearing publicly. The Magnificent Seven, Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla, now represent roughly 35 to 40% of the entire S&P 500 index. For anyone near or in retirement with a diversified portfolio or a simple index fund, that means more than a third of your retirement savings is concentrated in just 7 companies. Goldman Sachs has calculated what those 7 companies need to earn to justify their current valuations and justify the $527 billion they're spending on artificial intelligence infrastructure in 2026 alone. Here's what Goldman found. These companies need to generate over $1 trillion in annual profits to satisfy their investors. Their current earnings are projected to be $450 billion. They are $550 billion short. That gap matters to you, not because it guarantees a crash, but because it determines whether the math works or breaks. And Goldman Sachs, the institution managing trillions in retirement assets, has admitted the math is broken. For someone in the final decades of their career or already retired, this is essential to understand. The concentration of your retirement portfolio in these 7 companies is not a choice you made consciously. It happened because passive index funds automatically allocate money to the largest companies by market value. But this concentration creates what investment professionals call longevity risk, the possibility that a significant market correction happens exactly when you can least afford it, with no time to recover before you need to draw from your savings. On January 6, 2026, Ben Snyder, Goldman Sachs' head of U.S. equity strategy, published a specific calculation in their institutional research. He wrote, "Given consensus estimates for an annual average of $500 billion in Capex from 2025-2027, maintaining the returns on capital to which their investors have become accustomed would require these companies to realize an annual profit run rate of over $1 trillion, more than double the 2026 consensus estimate of $450 billion in income." In English, the Magnificent Seven companies are spending $500 billion per year on artificial intelligence infrastructure. To justify that spending and the way investors are valuing these companies today, those companies need to earn profits they are nowhere close to achieving. The gap is structural, not temporary. This matters because the retirement industry depends on certain assumptions. When pension funds and advisors build retirement plans, they typically assume the S&P 500 will return approximately 9 to 11% annually over long periods. They assume that assumption is safe. They assume that when you build a diversified portfolio of 500 companies, the concentration risk is managed. But concentration in the index itself, when 35% of the index is 7 companies, changes those assumptions significantly. Consider what happened in 2022. The Magnificent Seven stocks fell an average of 50% in that year. A retiree who was drawing from their portfolio and simultaneously saw their portfolio decline 50%, even if the overall market declined only 18%, faced devastating consequences. The combination of portfolio withdrawal and portfolio decline can exhaust savings far faster than standard retirement planning models assume. Retirement plans need to survive not just a 10 or 20% correction in the overall market, but a 40 to 50% correction in the 7 companies that comprise more than a third of the index. Now let's examine what Goldman is actually saying beneath the headline. The research includes a passage that bears quoting. The magnitudes of current spending and market caps alongside increasing competition within the group suggest a diminishing probability that all of today's market leaders generate enough long-term profits to sufficiently reward today's investors. This statement has a specific meaning in institutional finance. It means not all of these 7 companies will succeed. Some will fail to deliver the profits investors are expecting. Some will underperform. The market will be forced to choose winners and losers among the Magnificent Seven. But the market is currently pricing all 7 as winners. That pricing is wrong. For someone in retirement or approaching retirement, this distinction is critical. A 20 or 30% gain from the 4 winners in the Magnificent Seven may be completely offset by a 40 to 50% decline from the 3 losers. Meanwhile, the rest of the market, the remaining 465 companies in the S&P 500, may be rising steadily. The concentration actually works against the diversification that retirement planning depends on. Let's look at what's actually happening with the money. The Magnificent Seven companies are spending record amounts on artificial intelligence infrastructure. Microsoft is allocating $91 billion to Capex in 2026. Amazon is targeting $125 billion. Google is approaching $50 billion. These numbers are not hypothetical. These are actual capital expenditure commitments, and they're funded through two sources: operating cash flow and new debt. In 2025, the Big Five tech companies raised approximately $108 billion in new corporate debt specifically to fund data center expansion. That's actual debt in public markets, bonds sold to investors. When companies need to borrow $100 billion to fund Capex instead of generating sufficient cash from operations, it signals something important. It signals their cash generation isn't keeping pace with their capital spending. The free cash flow picture is what matters to a retiree. Free cash flow is the cash left over after a company pays for its operations and capital expenditures. Free cash flow is what eventually becomes shareholder dividends and stock buybacks. Free cash flow is the actual cash that justifies a stock's valuation. For the Magnificent Seven, free cash flow growth has been essentially flat, while Capex growth has accelerated 33.8% annually. That's a widening gap, a 5-year widening gap. Think about that in the context of retirement planning. A company that grows Capex faster than free cash flow is borrowing money to grow. It's taking on leverage. That's not inherently wrong, but it's riskier than the typical retirement fund assumes. And when you're living on your portfolio in retirement, risk is the enemy. Consider a specific example. Amazon's free cash flow collapsed from $3.6 billion in the fourth quarter of 2024 to negative $12.4 billion in the first quarter of 2025. That's a $16 billion swing. Why? Because Capex spending accelerated while revenue growth didn't keep pace. Meta's free cash flow turned negative on an annualized basis in certain quarters of 2025. Microsoft's free cash flow growth has been 6.6% annually, but its Capex growth has been 33.8% annually. The math is diverging. The divergence is accelerating. Now, companies will argue this is intentional. They're investing for future growth. The artificial intelligence infrastructure they're building will eventually generate massive profits. That argument might be correct, but here's what Goldman Sachs is saying. If that argument is correct, those profits need to appear within a specific time frame. If they don't, the current valuations don't make sense. Goldman's own calculation, $450 billion in current earnings, but $1 trillion needed to justify current Capex and valuations. That's a $550 billion gap. The company needs to grow earnings by 122% beyond current projections. For a retiree, this is important because it determines whether the portfolio will behave the way your retirement plan assumes it will. If earnings disappoint by even 10 or 20% relative to expectations, the correction could be significant. If earnings disappoint by more than that, which Goldman is implying is possible, the correction could be severe. Let's talk about what happens to valuations when earnings expectations decline. Currently, the Magnificent Seven trade at forward price to earnings ratios ranging from 19.57x for Google to 40.18x for Nvidia. These are high valuations. They reflect significant growth expectations already built into the stock price. When you buy a stock at 40x earnings, you're paying a premium that assumes the company will grow earnings faster and further than historical averages. If that growth doesn't materialize, the valuation contracts. This is called a multiple compression, and it's how 30 to 50% declines happen in individual stocks even when the company's underlying businesses remain healthy. For someone drawing income from a retirement portfolio, multiple compression is particularly damaging. If you're withdrawing 4% annually from a $1 million portfolio, $40,000 per year, and your portfolio declines 30% to $700,000, you've just forced yourself to withdraw at a much higher rate, 5.7%, just to maintain the same income. That accelerates the depletion of your capital. In retirement planning models, this sequence of returns risk is one of the most dangerous threats to portfolio longevity. The research Goldman published includes a very specific concern. They note that the Magnificent Seven companies are facing increasing competitive pressure. Alphabet competes with Meta in advertising. Amazon competes with Google and Microsoft in cloud computing. Microsoft and Google compete directly in search and productivity tools. The lines between different market segments have blurred, Goldman notes, meaning these companies are increasingly cannibalizing each other's revenues. When competition increases within a concentrated group, the probability of all seven winners decreases. Some will win more and others will win less or lose ground. This is where pension funds and financial advisors are beginning to make adjustments. Investment News reported in January 2026 that wealth managers are adjusting portfolios early in 2026 to contain concentration risk stemming from the Magnificent Seven. They're not abandoning tech stocks, they're reducing concentration They're rebalancing to ensure that a 40 to 50% decline in the largest companies doesn't devastate a retirement portfolio. Here's what that actually means. If your entire retirement portfolio is a single S&P 500 index fund, you have roughly 35 to 40% in the Magnificent Seven. If the Magnificent Seven declines 40%, your portfolio declines roughly 14 to 16%, assuming the rest of the market stays flat. That's a decline most retirement portfolios can survive, but if the rest of the market also declines, which happens during recessions, the combined effect is more severe. Goldman's own data shows that during 2022, when rates rose and the economy faced uncertainty, the Magnificent Seven declined 50% on average. A retirement portfolio that was 100% in equities and properly diversified declined roughly 18% that year. A concentrated portfolio in large-cap growth stocks declined more. The diversification, owning hundreds of different companies, is what protected portfolios. Concentration is what hurt them. Yet, paradoxically, concentration has increased. Why? Because these 7 companies have been the best performers. If you owned a simple index fund, you automatically own more of the winners as their values increase. You become more concentrated simply by holding the market. This is why financial advisors are now advising clients to proactively rebalance, to take some gains from the winners and reallocate to the rest of the market. Not because they think the winners will lose, but because maintaining prudent diversification requires reducing concentration as companies get larger. Goldman's research includes historical context that's important for retirement planning. During the dot-com era of the late 1990s, a handful of internet stocks became dominant. The concentration reached extreme levels. Then reality didn't match expectations. The Nasdaq fell 78%. Companies that were trading at 100x earnings fell 70 to 90%. Those were not diversified losses. They were concentrated losses in concentrated portfolios. Investors who were diversified survived. Investors who were concentrated were devastated. The research notes that conditions are different this time because today's tech giants are actually profitable. They actually generate earnings and cash flow. The dot-com companies often didn't. That's a legitimate difference. But the cautionary tale remains. Extreme concentration at extreme valuations can correct severely when expectations change, and expectations always change. For someone in the 60 to 70 age range, the timeline matters. If a significant correction happens in the next 5 years, you have very limited ability to recover before you need to draw from your portfolio. If it happens in the next 10 years, you have more time. But if you're already retired, even 5 years is compressed. You're likely drawing from the portfolio rather than adding to it. A 30 to 40% decline when you're drawing income is far more damaging than the same decline would be for someone who's still accumulating wealth. This is why Goldman's statement is significant. They're saying the math is questionable. They're not saying the Magnificent Seven will fail. They're saying that for investors to sufficiently reward themselves at current valuations, the companies need to deliver earnings growth that appears unlikely. That's a probabilistic statement. It's not a prediction. It's a risk assessment. Goldman's forecast for 2026 includes a specific contradiction that's worth noting. They predict the S&P 500 will rise 12% to reach 7,600. That's a bullish call. But they also predict that the Magnificent Seven will grow earnings 23%, still strong, but noticeably slower than the rest of the market's projected 12.5% growth. Translation: Goldman is forecasting that the Magnificent Seven will underperform relative to the broader market even as the broader market rises. That's a significant statement. It means the next leg of returns is expected to come from the companies outside the Magnificent Seven, not from them. For retirement portfolios, this has practical implications. If Goldman is correct, a diversified portfolio including stocks outside the Magnificent Seven will outperform a concentrated portfolio heavy in mega-cap tech. Over a 5-year period, that difference compounds. A 12% annual return outperforms a 10% annual return significantly over 5 years. For someone who's drawing from a portfolio, that 2% annual difference determines whether your portfolio lasts until age 90 or runs out by age 85. Let's talk about what you can do with this information. First, understand your actual exposure. If you own an S&P 500 index fund, you own the Magnificent Seven concentration by definition. If you own a total stock market index fund, which includes smaller companies, your concentration is slightly lower, roughly 22 to 25% rather than 35 to 40%. If you own an international or global stock fund, your concentration is much lower. The diversification varies by what you own. Second, consider whether you're comfortable with that level of concentration. If you're within 5 years of retirement or already retired, concentration risk is a legitimate concern. If you're in your 50s and have decades to recover from downturns, the risk is more manageable. The questions are, how long do I plan to be drawing from this portfolio? How would I feel if it declined 30 to 40% in the next 2 years? How would that affect my retirement timing or my ability to help family members? Third, understand that reducing concentration doesn't mean abandoning tech stocks. It means broadening your portfolio. Instead of owning only mega-cap growth companies, you might add mid-cap tech companies, international tech exposure, dividend-paying tech stocks, or non-tech exposure in healthcare, industrials, and financials. You still benefit if the Magnificent Seven continue to outperform, but you reduce the portfolio damage if they underperform. Goldman Sachs' research includes an important perspective from Vanguard analyst Qian Wang, who submitted independent commentary. She wrote, "We are bullish on AI's potential to transform the economy, but transformative technology needs profitable business models to win, and, in the financial markets, returns hinge on expectations. Tech companies' earnings have been strong so far, but their valuations may have gotten ahead of themselves. When expectations get too far out of whack, it is not surprising to see markets pull back." That statement captures the essential tension. AI is probably transformative, the tech companies are probably investing wisely, but the stock prices reflect the assumption that the profits will appear faster than the risk models suggest they will. When reality takes longer to catch up to expectations, prices correct. For a retiree, that correction is painful because it happens when you're most vulnerable, when you're living on the portfolio rather than building it. One more detail from Goldman's research bears mentioning. They note that the Capex spending itself, the $500 billion being deployed for artificial intelligence infrastructure, is slowing as a growth rate. Goldman projects Capex will grow 73% year over year in 2025, but only 19% year over year in 2026, slowing to perhaps 10 to 15% growth in subsequent years. That's a deceleration. When growth decelerates, markets typically reprice lower. They value a company with 10% growth less than they value a company with 30% growth, even if both companies are fundamentally sound. For retirement planning, this matters because it suggests the current Capex boom, which is driving bullish sentiment, is near its peak. That doesn't mean it will reverse. It means the growth rate will normalize. When growth normalizes, sentiment often cools. That's when corrections typically happen. The research from Goldman and from multiple pension funds and financial advisors suggests a prudent approach for someone in retirement or approaching it. Maintain exposure to quality companies and technology innovation, but reduce concentration in the 7 most expensive mega-cap growth stocks. Consider adding exposure to dividend-paying companies, international markets, and sectors that are uncrowded. Rebalance your portfolio annually to ensure that your concentration doesn't drift upward as winning stocks appreciate. Maintain sufficient cash or bonds so that you're not forced to sell equities in a downturn just to cover living expenses. This isn't about fear, this is about prudence. Goldman Sachs isn't saying the Magnificent Seven will fail. They're saying the math suggests the bar for success is very high, and when the bar is very high, not all companies can clear it. When some fail to clear it, and history suggests some will, concentrated portfolios suffer. Your retirement depends on your portfolio surviving not the average year but the difficult years. It depends on your portfolio sustaining you through market cycles, inflation, unexpected health costs, and potentially decades of withdrawals. That durability comes from sensible diversification and avoiding excessive concentration, even in wonderful companies. Goldman Sachs just admitted that the math doesn't work for all 7 companies to simultaneously deliver the profits their current valuations require. That admission doesn't predict a crash, but it suggests that prudence is warranted. For someone in retirement or approaching it, prudence has always been the appropriate strategy.